Dividend stocks are very popular amongst investors who want a steady income stream. However, they are seldom paid by those flashy growth companies we generally want to include in our portfolios to build our nest egg. So does it make sense to include them in a growth portfolio? Take a look at the video to find out. Hi there, I'm Michelle. Welcome to my channel where we talk money and having more of it. And in this video, we're going to take a look at dividend stocks and how even a growth-focused portfolio could benefit from the relative stability that they bring to a portfolio. Let's start with quickly touching on what dividends are. So what is a dividend exactly? It's a portion of a company's profits that is paid out in cash or shares to the shareholders of that company. So while dividends individually may seem quite insignificant, if they are reinvested, they can add up to a significant portion of investment returns. The FTSE 100, for example, over the last 20 years has been relatively flat if you just look at the valuation increase. However, if you factor in reinvested dividends, the return is close to 94%. Dividends are, of course, not guaranteed, and the amount, the timing, and the method of payment, whether it is cash or shares, will be determined by the board of directors. So the next thing to consider is why include dividend stocks in your portfolio. Firstly, dividend stocks provide a regular income, especially for those investors who are invested in companies with a long history of paying dividends. Just on that note, there are in fact some companies who have consistently increased their dividend amount each year for the last 25 years. And these are called the dividend aristocrats. And within this elite grouping, there are even a few called the dividend kings who have done so for the last 50 years. Secondly, dividend paying companies tend to be those which have a low but steady growth trajectory, and they normally have stable but predictable earnings. Thirdly, though the payment of dividends is not guaranteed, an allocation in your portfolio to a basket of dividend-paying stocks may provide a more inflation-resilient return. If these dividends are increased above inflation, then possibly a fixed income allocation may do. So if you have a portfolio with an allocation to the more inflation-resistant or resilient dividend-paying stocks and an allocation to the fixed income stocks, you have the ability to withstand potentially both inflation and market fluctuations. Dividend stocks, however, are not without their risk. So in the next step, we're going to take a look at what these risks are and what to look out for. When assessing which dividend stocks to choose, investors look at the dividend yield as a metric. This is the dividend per share over the price per share. So if the price per share has decreased, the dividend yield starts to look like a very attractive return. But the question is it? If a company has a significantly higher dividend yield than its peers, this could be a red flag rather than a green light. Look at the other metrics to see how secure the dividend is. So firstly, take a look at the company's dividend paying history. Has it paid dividends consistently, and have they been increasing over time? Secondly, take a look at the company's dividend payout ratio. This is how much of the company's earnings it is using to pay dividends. And so the lower the percentage of its earnings that it's using to pay the dividend, the more sustainable that dividend is likely to be. The follow-on from this, of course, is to see how much of the company's operating cash is available to pay the dividend. And this is the cash payout ratio. And again, you want to see that there's more than enough cash to pay the dividend. So the dividend payment is a small proportion of the operating cash. Lastly, look at the company's financial stability. Do they have a significant amount of debt? Do they have cash available to service their debt? What's been happening with their revenue and their earnings? And consider any other negative news related to that company's business or its industry. The reality is that if the dividend yield looks too good to be true, it probably is too good to be true. Let's take a look at some last points to consider. Dividends held in your pension or your ISA in the UK will not be subject to tax. However, if you're holding them in a general investment account and you exceed the tax allowance, they will be subject to tax. So it's possibly a consideration to rather include your dividend paying stock into one of your tax efficient vehicles. Also remember, if you are a long-term investor and you're looking to build your nest egg, the best approach is to reinvest your dividends. You can select to do so automatically if your broker offers this facility, which could also save you the cost of the future commissions of having to reinvest the dividends yourself. And finally, you can easily build your dividend basket by investing in a fund or an ETF comprising of dividend stocks, and save yourself having to individually select these stocks. If you are interested in learning more about investing, take a look at my website for the investing courses and webinars I have on offer. If you like this video, please let me know by liking it and share it with any other ladies who want to change their financial stories. Thank you so much for watching my video the whole way through. If you want to hear more talk about money designed especially for women, please subscribe to my channel.